Welcome to the Deep Dive, the show where we, sift through all the information so you don't have to. We aim to get you well informed without feeling overwhelmed.
That's the goal.
Today, we're lacing up, grabbing our skateboards maybe, and diving into Zumiez Inc.'s Q2 fiscal year 2025 earnings call.
Yep, Zumiez, always an interesting one in the youth retail space.
Exactly. So think of us as your guides. We'll cut through the noise, summarize the key financials, dig into what management's thinking strategically.
And figure out what it all means for them, right?
Right. Our mission is just to get you up to speed on what really matters from this call. And look, if you've been watching the market, you probably saw some buzz already.
Oh yeah, the stock reacted pretty quickly.
Positively.
It did, which sort of sets this maybe cautiously bullish tone for our chat today.
Cautiously bullish, I like that. Sounds about right for retail these days.
Okay, so let's unpack this then. Zumiez just dropped its Q2 results, and like you said, the street seemed pretty enthusiastic. I mean, an 11% jump after hours, that's a strong signal.
It definitely catches your eye. So what were the standout figures? What got everyone's attention and sparked that kind of reaction?
Well, yeah, the numbers certainly delivered more punch than maybe people expected, especially given, the broader retail climate.
Right.
So for Q2 fiscal 25, Zumiez reported a GAAP EPS that's the earnings per share of negative $0.06. Now that might sound bad, negative 6 cents.
But it's all about expectations, isn't it?
Exactly. The consensus estimate was actually negative $0.11. So beating that by nearly half, that's significant. It suggests, better operational control than feared.
Okay, so a much smaller loss than expected. What about the top line, revenue?
Revenue came in strong, too. Yeah. $214.3 million. Again, comfortably beating the $210.5 million consensus.
So another beat, and year over year.
Actually up 1.9% year over year. So real growth there, not just beating the low bar. And maybe the most impressive part, driving that investor confidence perhaps, was the gross margin. Came in at 35.5%.
Which is
a big jump. 130 basis points, so 1.3 percentage points better than last year.
Wow.
Yeah, so it tells you they're not just selling more stuff, they're actually making more profit on each sale.
So better than expected earnings, solid revenue growth, much healthier margins. That's quite the trifecta.
It really is.
But, the real story is often under those headline numbers. How did comparable sales look? What does that tell us about actual customer demand?
That's the key question, right? So comparable sales at stores open at least a year, they saw a consolidated increase of 2.5%.
Okay, positive.
Positive, yes. But the real star, honestly, was North America, up a very impressive 4.2%.
4.2% in North America. That's strong.
It is. And what's really remarkable, this isn't just a one-off. It's actually North America's 6th consecutive quarter of positive comp sales growth.
6th? Wow.
Yeah, and the company's 5th overall. Yeah. So that kind of sustained momentum, it suggests something more fundamental is working for them, not just a lucky quarter.
Right, it points to a strategy paying off.
Exactly. And, looking at their balance sheet, their financial health, they're still operating from a position of strength.
How so?
They've got a solid $106.7 million in cash and marketable securities. And crucially, zero debt.
No debt. That's huge in this environment.
It gives them immense flexibility, yeah. Inventory was also managed really well, basically flat year over year at $157.7 million.
So no big overhang there.
Nope. Signals disciplined control, avoiding those costly markdowns. And they kept buying back shares, too. Bought back 0.6 million shares for $7.8 million just in Q2, returning value to shareholders. Okay.
Shows confidence, right?
Definitely. So that's strong financial footing, beating expectations across the board. Yeah, I can see why the stock jumped 11% after hours. Investors clearly see resilience.
Makes sense.
But let's dig deeper. Beyond the headlines, what's really driving this sales momentum, especially when, like you said, other retailers are struggling? What's the engine behind that accelerating top line?
Yeah, this is where it gets really interesting because the sales trends, they didn't just hold steady in Q2. They actually accelerated through the quarter.
Yes. And even better, that acceleration continued into Q3, or at least the start of it. Give them Q3 to date numbers.
Well, they did. What did those show?
For the 30 days ending September 1st, net sales were up 10.6%.
10.6%. Okay.
And comparable sales were up even more, 11.2%.
Whoa.
And North America, again, the powerhouse, up 13.0% comp sales in that period.
13% comp in North America to start Q3. That's not just an uptick, that's a surge.
It really is. Significant momentum. Now, digging into why, The main driver for comps over the last, say, 5 or 6 quarters has been a steady increase in average unit retail, AUR.
Okay, AUR. So the average price of items sold is going up.
Correct. Think of it as the average ticket price per item. And this isn't just inflation-like, right? It seems pretty strategic.
How so?
Well, they've done targeted price increases, especially gearing up for back to school. That's a key season for them.
Makes sense.
We're also seeing positive mix shifts, meaning customers are buying more of the higher price stuff, particularly in apparel category. And their private label pricing strategies seem to be working effectively too. We can talk more about private label later. It's a big story here.
Yeah, definitely want to circle back to that. So it's this multi-pronged approach driving up the average sale value.
Pretty much.
But, is AUR growth always a good sign on its own? Could it just mean fewer people are buying, but they're buying more expensive things? What about transaction volume?
That's a critical point, yeah. And that's where the Q3 to date data is really encouraging.
What is that?
Because for that recent period, they saw increases in both dollars per transaction and total transactions.
Oh, okay. Both are up.
Both are up, which tells us it's not just about selling pricier items to fewer customers. It suggests broader strength. People are spending more and coming in more often, or at least buying more units.
So genuinely healthier demand.
It looks that way, yeah. Suggests stronger engagement with the brand and the products.
That really does tie into their agility, doesn't it? Product, customer experience. They seem to be actively shaping their growth, not just reacting.
Seems so.
It's clear they're not just selling more. Like we said, they're selling smarter. So let's go back to that gross margin expansion, that 130 basis point jump. What's the secret sauce there?
Right, yeah, that margin story is key. It wasn't a fluke. It was mainly driven by two distinct areas, each kicking in about half the benefit.
Okay.
So about 60 basis points came straight from product margin improvement, better pricing, better mix, maybe better sourcing.
Got it. Higher profit on the goods themselves.
Exactly. And the other 60 basis points came from leveraging store occupancy costs.
Leveraging occupancy? Meaning what?
Basically spreading their fixed costs, like rent, over higher sales. With sales up, and importantly some strategic store closures, each remaining store is, on average, more productive, making those fixed costs a smaller percentage of sales.
Efficiency gains from higher volume and optimizing the store footprint.
Precisely. And tied into that product margin piece is something truly standout, their private label penetration.
You mentioned that earlier. What's the story there?
It's hit a record high. Their own brands now make up 30% of total sales year to date.
30%. Wow, up from what?
Up from 27% a year ago. Highest it's ever been for them.
That's huge.
It is. And crucially, Zumiez isn't positioning these private labels as, like, the cheap alternative.
No.
No, they call it a premium price player. They're not trying to be the value option. And this approach gives them a significant margin boost. Maybe 10–15% better margin compared to selling third-party brands.
10 to 15% better margin on 30% of their sales. Okay, that's a serious profitability driver.
Absolutely. And it also shows they're good at spotting and even leading trends, especially what they call cut and sew categories like denim, stuff they design and have made, rather than just slapping a logo on something.
Right, more control, potentially higher margins. So private label is really a core strategic engine, not just a side thing.
It seems central to their model now, yeah.
Yeah.
Demonstrates they really know their customer and the trends.
Okay, so strong product margins, leveraged occupancy, massive private label contribution. How are they doing on other costs, like SG&A selling, general, and admin expenses?
Also managed pretty effectively. SG&A remained relatively flat as a percentage of sales. Came in at 35.4% year over year.
Flat even with sales growth.
Well, flat as a percentage of sales, which is impressive considering they actually faced some increases in corporate costs, some legal settlements, and higher compensation.
So they kept a lid on it relative to the sales increase.
Exactly. And management's aiming to leverage SG&A even further in Q3 and for the full year, meaning they expect sales to grow faster than these operating costs, leading to more efficiency gains.
It really shows how all these strategic pieces fit together, hitting the bottom line. Very disciplined.
Yeah, a multifaceted approach to driving profit.
Okay, so that's the financial picture. But every company operates globally, right? There are always pockets of strength and areas needing work. Where is Zumiez finding its biggest success, and where are the challenges they're focused on?
Well, connecting back to the comp sales, it's clear the North American business is really the standout, showing that outsized strength and resilience, as they put it.
That 6th straight quarter of positive comps definitely points that way.
Right. It's the main engine driving performance. where the strategy seems to be firing on all cylinders.
But what about internationally? Europe, Australia.
Well, that's a different story. More challenging. Europe especially continues to face what they called difficult market conditions.
Macro factors.
Yeah, they specifically mention things like stagnant growth in Germany, geopolitical issues hitting consumer confidence, the usual European headwinds we've heard from others.
So a real contrast with North America.
Stark contrast, which presents that strategic question, right? Do you double down on the winner or fix the laggard?
And their answer is?
They're playing the long game in Europe, it seems. They have a multi-year plan aimed at just getting the European operations back to break even.
Just break even. So it's dragging down overall results now.
It appears so. If you combine Europe and Australia, their other international net sales actually decreased 4.2% in Q2 on a constant currency basis. So yeah, definitely a headwind.
Okay, geographic divergence is clear. What about byproduct category? Any surprises there? Winners or losers?
On the product side, footwear is still what they called a very challenging category. Several brands underperforming there.
That's been tough for a lot of retailers, the footwear piece.
Has lots of shifts happening, so Zumiez is feeling that pressure too.
Any bright spots?
Interestingly, yes. The skate hard goods business, boards, trucks, wheels that actually turned positive recently.
Really, skate's back.
Yeah, maybe a mini comeback. They offer cautious optimism there, but they also acknowledge it's pretty cyclical and usually slows down seasonally. Still, it's a positive sign, maybe points to that loyal core skate customer sticking with them.
Interesting. So varying performance across geographies and categories, it definitely raises the question about the longer term view. What kind of guidance did management give looking ahead to Q3 and the full year? And what big worries are they keeping an eye on?
Okay, guidance. For Q3, they're expecting revenue between $232 million and $237 million.
Okay.
Comparable sales projected to grow between positive 5.5% and 7.5%.
Still strong growth, building on Q2 and that hot start.
Yes, reflecting that momentum. Operating margin is forecast between 2.3% and 3.3% of sales.
Leading to
an estimated EPS between $19 and 29 cents for the quarter.
Okay, back in positive territory for Q3 earnings.
Right. Now, management described this outlook as prudently balanced.
Meaning,
yeah, they see the strong domestic back-to-school momentum, the great Q3 start, but they're tempering that with some near-term caution.
Why the caution?
General macro uncertainty, basically. And they specifically observed some softening in consumer traffic during non-peak times. So they're not getting carried away by the recent surge, being realistic.
Okay, prudently balanced. Got it. What about the full year, fiscal 2025?
For the full year, they're projecting overall sales growth of 3% to 4% compared to last year.
Modest, but positive?
Modest, positive. They also expect slight year-over-year growth in product margins, and importantly, an increase in operating margins and net profit overall. The clear goal is to get the whole company back to profitability for the full year.
That's the target. Any store plans mentioned?
Yeah, continued optimization. They plan to open up to 6 new stores, 5 in North America, 1 in Australia, but also close around 20 stores.
Net decrease then, rationalizing the footprint.
Seems like it. Key part of improving that overall efficiency we talked about.
Okay, so they're cautiously optimistic, balancing the good operational stuff with a wary eye on the big picture. What specific macro worries did they flag?
They explicitly mentioned ongoing tariff policies. That's always a background concern for retailers sourcing globally. And just broader consumer demand worries, how resilient discretionary spending will be.
Standard retail anxieties these days.
Pretty much. But this is crucial. What gives them room to navigate this is that strong financial foundation we keep coming back to.
The cash and no debt.
Exactly.
Yeah.
$106.7 million cash, 0 debt. Plus, they still have $7.2 million left on their share buyback authorization.
Right.
That financial strength is huge. It lets them manage volatility, fund store changes, keep buying back stock. It allows them to be prudently balanced instead of just reacting defensively. It's a key asset.
Absolutely. A strong defense in uncertain times.
Yeah.
Okay, so it really is this picture of solid internal execution bumping up against those unpredictable external factors.
That sums it up well.
All right, now we're going to pivot. We do this segment called This Is Not Financial Advice, and we mean it. What we're about to discuss is purely for entertainment, for thought experiment purposes only.
Definitely not advice. Please don't run out and do this based on our chat.
Absolutely not. Always, always do your own research, consult professionals. This is just us kicking around an idea based only on what we heard in the earnings call.
Got the disclaimer loud and clear. So, okay, building on everything we just dissected, Here's an outrageous but plausible trade idea. Again, just thinking out loud here.
Lay it on us.
Given the known retail volatility, those macro risks management flagged, maybe consider a highly targeted, leveraged long position on Zumiez stock.
Leveraged, like options.
Possibly. Maybe call options expiring shortly after their next earnings release, the Q3 results likely coming in December.
Okay, why is that outrageous and why plausible?
The outrageous part is obvious, right? Retail is choppy, macro is uncertain, options are inherently risky. Betting on continued momentum is always a gamble.
Right, high risk.
High risk, but the plausibility that's anchored in the data points we just covered.
Such as?
Such as the double-digit comp growth they're seeing right now in Q3 to date.
Yeah.
11.2% overall, 13% in North America. That's hot.
It is very strong momentum.
Add the record high private label penetration, which we know is boosting margins significantly. That's a real profit driver. And then there's the implied momentum carrying into the crucial holiday season. If, and it's an if, but if, they can sustain even a good chunk of this current strength.
Then keep using that buyback.
And keep using that $7.2 million authorization to buy back stock, further boosting EPS. Well, you could see a scenario where strong results or even just anticipation before the Q3 earnings act as another catalyst.
Propelling the stock beyond that initial 11% pop we saw after Q2.
Potentially. It's basically a short-term bet that their operational execution continues to outweigh those perceived macro risks, rewarding investors who take that targeted gamble.
Yeah.
Outrageous.
Yes.
Plausible based only on the call, maybe.
Definitely food for thought and a great illustration of how earnings data can spark speculative ideas, even if they're not actual advice.
Exactly. Thought experiment only.
Okay, so we've really covered a lot today on Zumiez's Q2. That surprising strength, especially North America, the huge role of private label in boosting margins, their strategic efforts to tackle those international challenges, and that cautiously optimistic outlook.
Yeah, I think the key takeaway for me is how their focused strategy, product innovation, careful inventory, knowing that youth customer seems to be a really effective playbook for navigating this tricky retail world right now.
It really does stand out.
Their ability to drive AUR, hit record private label levels, manage costs, especially with all the macro noise, it's quite the differentiator.
Absolutely. Well, thank you for joining this deep dive into Zumiez's Q2 earnings, and thanks to you, our listeners.
Yeah, thanks everyone.
And remember, one last time, everything discussed here is for informational purposes. It is absolutely not financial advice. Keep digging, keep learning, form your own conclusions. Until next time.